Hey everyone, welcome back to Finance Plus Investment, the channel dedicated to helping you make smarter financial decisions. Today, we're diving headfirst into the world of investing with a comprehensive beginner's guide for 2025. Whether you're starting with a few $100s or a few thousand, this video will equip you with the knowledge to start growing your wealth. We'll be covering everything from choosing the right investment accounts, to understanding different asset classes, and even common pitfalls to avoid. So if you're ready to take control of your financial future, stick around. Now let's kick things off by talking about retirement accounts. I know retirement might seem like a lifetime away, but trust me, starting early is crucial. Plus, these accounts come with some sweet tax advantages. The most common ones you'll come across are 401(k)s and IRAs. 401(k)s are typically offered through your employer, and the beautiful thing is, contributions are taken directly from your paycheck before taxes. That means you're lowering your taxable income, leaving you with more money in your pocket right now. And here's the kicker, many employers offer something called an employer match, where they'll actually contribute to your 401(k) based on how much you put in. It's essentially free money, guys. Now on the flip side, we have IRAs or individual retirement accounts. These are perfect if you're self-employed or want more control over your investments. You've got two main options here, traditional and Roth IRAs. With a traditional IRA, your contributions might be tax deductible, meaning you could pay less in taxes today, but you'll get taxed on the money you withdraw in retirement. With a Roth IRA, though, your contributions aren't deductible, but withdrawals in retirement are tax-free. This is a huge perk, especially if you think you'll be in a higher tax bracket in retirement. For 2025, you can contribute up to $22,500 to a 401(k) and $7,000 to an IRA. Take advantage of these accounts, max them out if you can, and you'll be thanking yourself later. Now let's talk about the golden rule of investing diversification. You've probably heard the saying, don't put all your eggs in one basket. Well, the same principle applies to investing. You don't want to put all your money into one single stock or asset class. Why? Because if that one investment tanks, your entire portfolio takes a hit. Instead, you want to spread your money across different asset classes, industries, and even geographic regions. This way, if one investment isn't doing so hot, the others can help cushion the blow. Think of it like building a well-rounded breakfast plate. You wouldn't just eat a plate full of bacon, right? You'd want some eggs, maybe some toast, some fruit for balance. Investing is the same way. Now you might be thinking, Graham, this all sounds great, but how do I actually diversify my portfolio? That's where investment funds come in. These are like pre-built portfolios managed by professionals. You've got two main types, index funds and target date funds. Index funds are like the autopilot of investing. They passively track a specific market index like the S&P 500, which includes a basket of 500 of the largest U.S. companies. The idea is that by investing in an index fund, you're essentially investing in a small piece of all those companies, giving you instant diversification. Now, target date funds are even more hands-off. You choose a fund based on the year you plan to retire, and the fund managers automatically adjust the asset allocation over time to become more conservative as you get closer to retirement. Both index funds and target date funds are fantastic options for beginners because they offer built-in diversification and are relatively low cost. Okay, now that we've covered diversification, let's talk about the different asset classes you can actually invest in. The most common ones are stocks, bonds, mutual funds, and ETFs. Let's start with stocks. Stocks represent ownership in a publicly traded company. When you buy a stock, you're basically buying a tiny slice of that company. Stocks are considered higher risk investments because their prices can fluctuate significantly in the short term. However, they also offer the potential for higher returns over the long run. Next, we have bonds. Bonds are essentially loans that you make to governments or corporations. When you buy a bond, you're lending money to the issuer for a fixed period, and in return they agree to pay you back the principal amount plus interest. Bonds are generally considered less risky than stocks because their prices tend to be more stable. Now remember those mutual funds we talked about earlier? Those fall under the umbrella of investment funds, and they pool money from multiple investors to invest in a diversified portfolio of assets. ETFs, or exchange-traded funds, are similar to mutual funds, but they trade on stock exchanges like individual stocks. Both mutual funds and ETFs offer a convenient way to diversify your portfolio without having to buy individual stocks or bonds. Now, when it comes to investing, it's essential to strike a balance between short-term and long-term investments. Short-term investments are best for money you'll need in the next few years, like an emergency fund or money for a down payment on a house. These investments typically offer lower returns but are also lower risk. Think of things like high-yield savings accounts and money market accounts. These are great for preserving capital and earning a little bit of interest. On the other hand, long-term investments are for goals that are further out, like retirement or your kid's college fund. These investments have the potential to generate higher returns over time, but they also come with higher risk. This is where stocks and real estate come in. The key is to figure out your time horizon, risk tolerance, and financial goals to determine the right balance for you. Alright, before we wrap things up, let's talk about some common mistakes that new investors make and, more importantly, how to avoid them. One of the biggest mistakes is getting caught up in the hype in investing based on emotions. It's easy to get swept up in the excitement of a hot stock or market trend, but it's crucial to make rational decisions based on your investment plan and risk tolerance. Another common mistake is over-involvement. Constantly checking your portfolio and making frequent trades can actually hurt your returns in the long run. Remember, investing is a marathon, not a sprint. It's also crucial to avoid misusing retirement accounts. These accounts are designed for long-term savings, so withdrawing money early can result in hefty penalties and taxes. The best way to avoid these mistakes is to educate yourself, do your research, and don't be afraid to seek advice from a qualified financial advisor. And that brings us to our final point. Investing is a lifelong journey of learning and adapting. The financial landscape is constantly changing, so it's essential to stay informed about market trends, new investment opportunities, and changes in tax laws. Make it a habit to read books, listen to podcasts, and follow reputable financial news sources. Remember, knowledge is power, especially when it comes to managing your money. And if you're ever feeling overwhelmed or unsure about something, don't hesitate to reach out to a financial advisor. A good advisor can help you create a personalized investment plan, answer your questions, and guide you toward your financial goals. So, there you have it, a crash course on how to start investing in 2025. Remember, the most important step is to just start. You don't need a ton of money or experience to begin investing. Even small contributions can add up significantly over time thanks to the power of compound interest. The key is to be consistent, stay informed, and make smart investment decisions that align with your financial goals. Thanks for watching, and remember to subscribe for more videos on personal finance, investing, and building wealth.